Hey, welcome to the video, everyone. So, we're going to go ahead and talk about Warner Bros. Discovery now that things have settled down a little bit and they have finished the merger. Remember, before this, they were two separate companies, Warner Media and Discovery. AT&T wanted to spin them off so they could focus on being a telecommunications company, and Warner Media and Discovery thought it'd be a really good idea to merge together. Well, now that the dust has settled a little bit, I have a little more statistics I can look at to actually do a proper DCF model on this newly merged company. Now, do remember that we have to come up, of course, with a growth rate that we want to apply. And because this is a newly merged company and we're not entirely sure how everything's going to work out, it was kind of really hard to come up with a growth rate that I want to apply over the next 5 years. From 2022 to 2023, an average of 21 analysts had the company growing at about 12.5%. I was thinking, oh, okay, then, we'll stay a little conservative and I'll use 10%. However, with Warner Bros. Discovery being a newly merged company, there's kind of some unknowns in there in terms of how they're going to work together. I mean, will they do average? Will it do phenomenally? Or will it do below what people think? Overall, just because of all the unknowns, I decided to go with 5% revenue growth over the next 5 years. That may sound extremely conservative, but that's what we're going to go with. Also, going to say it ahead of time so that we can streamline this DCF model that we're about to jump into. We had to figure out a free cash flow margin, and that really wasn't exactly 100% easy to do because we don't know how the new company is going to work together. So we went based off of what we had to work with. I took the revenue for Discovery and the revenue for Warner Media and added them up for the year 2021. And that was roughly $47.7 billion. I also took the generated free cash flow for both of them during those years and added them up. Discovery was about $2.4 billion. And it's hard to know the exact amount for Warner Media because I went through all of the earnings for AT&T, who of course owned Warner Media before, and they made it just really difficult to get any actual numbers. Somewhere within their earnings, as I read page after page after page, and they didn't want to reveal exact amounts, but basically they said Warner Media for 2021 generated roughly $3 billion in free cash flow. So that's the figure I decided to go with. Added together, 2021's free cash flow generation for the two companies was about $5.4 billion. And that gives us a free cash flow margin of 11.35%. But just for the model, let's round it down to 11%. Okay, we've got the numbers that we kind of needed to figure out, so let's go ahead and jump into the model. However, before we get to that, if you like these kind of videos and think they add value to your day and they're helping you out when you look at a stock, make sure you subscribe to the channel. And if you think that these kind of videos could help other people out too, make sure you like the video for the algorithm so that we can get the video out to more people. And with that, let's jump right into this DCF model. I'm excited for this one. Okay, so Warner Bros. Discovery. First of all, we applied a growth rate of 5% all the way out to the year 2026 and got to a revenue of about $55.5 billion. As we discussed, we're using a free cash flow margin of 11%. We apply that margin to all projected revenues and we get projected future free cash flows. Then, of course, you know that we need to come up with a terminal value. We get that terminal value by applying a weighted average cost of capital. And we also need to apply a perpetual growth rate, which I like to use 2.5%. Okay, great. Now we need to apply our discount rate or rate of return that we want, which I like using 12%. After that, we add all the values up, then divide by shares outstanding, and we get an intrinsic value for the company today of 37.45, or let's just round it to 37. So that gives us a fair value for the company today of $37. Okay, so I don't think I need to tell you that based on what I feel is a very, very conservative model of 5% revenue growth and 11% free cash flow margin, we come out with an intrinsic value of $37 a share. Obviously that represents a huge amount of upside potential from, I think it's around 21 a share right now or something. However, I didn't want to stop there. If people thought that I was a little too conservative in this model, saying 5% revenue growth over the next 5 years, I also ran another model that used 10%. I didn't make an actual DCF model on the computer for you to look at. However, the intrinsic value for 10% revenue growth over the next 5 years came out to 44.2, or we can call it $44 a share. So if you believe that they can do 10% revenue growth over the next 5 years on average, then the fair value is about $44 a share, and from this point here represents more than a 2x. However, we have one more projection to look at, and it's the projection from management. Management said that by 2023 year's end, that they expect free cash flow to be anywhere from 8 to 9 billion. Obviously, I can pull up my model again here and you see that we're nowhere close to that. Now, yes, we were conservative on the model. However, even at the 10% revenue growth, it didn't even come close to that. I personally believe that management for Warner Bros. Discovery is being a little overzealous here. However, based on what they're saying free cash flow could be by year 2023's end, I wanted to do a projection based on that and get a fair value. So, first of all, they said 8 to 9 billion in free cash flow generation. Let's skip the 9 and let's just take the lower end there and go with 8 billion. By the way, for this calculation, I still used my 5% revenue growth rate over the next 5 years. And when everything's said and done, the calculated share price came out to 59.6, or let's at this point call it $60 a share. Yeah, personally, I think they're smoking something. Now, granted, remember, they're basing this off the year 2023, so that's where I started growing the revenues out. So according to management, this isn't the value for today. So they're saying that by 2023's year end, that the share price should be worth $60 a share. I personally don't think that they're gonna hit 8 to 9 billion in free cash flow generation by 2023, but hey, that'd be a welcome surprise for investors. And by 2023, if they really can produce that much free cash flow, that would represent from current share price almost a 3x by 2023. That's a really good return on your investment. However, that's based on, again, what I feel is a fairly over-the-top estimate by management. Only time will tell, but even according to the model with 5% revenue growth, we're still looking at quite a bit of upside for this based on the model. Okay, everyone, that's all I've got in this video. Let me know what you think down below about Warner Bros. Discovery. Do you own any shares? Are you looking to buy shares? Let me know what you think down below in the comments. Okay, that's all I've got for you guys. I'll see you in the next one.